Alright guys, so this is your day one refresher video. It's going to be the longest video out of every single video you watch going forward. Now, if you've received the list, or if you've seen the list, you know that there's a lot of videos and they pretty much grow as time goes on. I personally believe that the market teaches new lessons in different market conditions, and it's always good to recap on those lessons with a simple video. Some videos are much longer than others, and as time has gone on, in my coaching career, I have learned to make them a little shorter just to keep your attention. But with this video, it is going to be pretty long because we're going to be covering a lot of things. Now, this video is going to cover some basics. It's also going to cover some navigational things within the actual platform. We're going to go over some rules and the whys. Most of the stuff you heard in the session, but sometimes first session your mind is all over the place. So I try to get you here on the same page, and if not here, then on the second session or the third, or however many it takes. But point being, video is going to be a little long. Now we're going to break down, like I said, the platform a little bit, some of the key areas, not everything. Obviously, some things are going to get missed. If you're new to trading, you don't understand yet that trading is all about the details, little details that can only be learned over time and through actual trading. You could conceptualize this as much as you want. You could watch as many videos, read as many books, listen to as many seminars, have tons of sessions. But if you're not actually trading, it's not going to make any sense to you. So some of the terminology gets learned over time, some of the indicators and what they really do. Even though you could be explained a million times what they do and how to use them, you got to actually use them. You got to trade. That's the only way to start formulating an actual trader's mindset. Logically, trading. We're also going to break down the indicators. We're going to break down the charts, the marking up, and then that's pretty much it. So video should be about an hour and some change, and hopefully you get all the value out of it that I expect you to get. So let's start. First things first, let's start with our toolbar. Up top, you have your charting window. This is the area where you are opening your chart. The different pairs that you use. Most people ask me, what do I trade? I trade GBP JPY, USD JPY, NZD JPY. Yes, there's a reason why they're all JPY. Because if they're all moving in one direction, I know which asset is running which one. So, for example, if they're all dropping on the JPY, then I know that JPY is running the show as far as the strength of the market. GBP USD, GBP and Euro USD are my other two pairs that I like. I also trade GCAD, but most people know me for GBP JPY. Now, why do I trade one of the most aggressive pairs within all of them? Because I feel that if you can learn GBP JPY, if you can really break down the GBP JPY, a market that moves like this and then all of a sudden spikes up, a market that has strong moves, whipsaw moves of 100 pips up and 100 pips down, things like this within 2 days. All right, if you could learn to maneuver in that type of market, you can trade any pair, because a pair is a pair. It doesn't matter what you're trading, they all follow the same structural rules, technicals, fundamentals. The only difference is your expectation of the type of movements you're going to get volume-wise, how fast your pips are going to come and how fast your targets are going to get hit. With GBP JPY, you could be 200 pips out and same day hit that target. You can see a breakout of 30 pips and it can wick you out and go back in the direction it came from. Something like here. All right. So because of that, the GBP JPY is a great training tool. And honestly, I think because I started there, it made me a better trader. I am way more patient than most. I feel that the market will get to where I want it to get to, my price targeting. And because of that, it keeps you profitable. The worst thing you can do in trading is put yourself in a trade that is of no quality. And for some of you, that may not mean anything, but eventually you'll get exactly what I'm talking about. So here's your charting window. Your chart window, chart list. Then you have your navigator. So what you have on your navigator is your indicators. When you open that up, your indicators, your account numbers, all that stuff is going to come up. Bunch of indicators. If you've been like me around for a long time, you're probably going to have a massive indicator list. Things that you tried that you found out didn't work. By the way, please, no looking for magical systems because they don't exist. Take it from me. I've spent money on trainings of this, that, and the other, and all of it is garbage. What you are learning is what most people that have been trading for a long time state, which is you can't take shortcuts in this. You got to learn the foundations of things. You got to learn your price action. You got to learn your price targeting. You got to learn your market structure. You got to learn to recognize market environment. You got to learn to lose gracefully. Some of these great basics that really can take you to the next level in your trading. So after that, your data window, which is where your terminal, which is where you're going to see your open trades, where you're going to see your balance and equity and all that good stuff, and how you close your trades by hitting X on the right side of your screen. Bring that. By hitting X on the right side of your screen. Simply boom, and you're out of the trade. You have taken profit. Now, what else do you have? You have your crosshair, which is the one that most people don't know the power of, and that's how you measure your volume. Now, you go to the crosshair. If you have a mouse, you can actually hit your mouse wheel 3. Just click the mouse wheel, and it'll bring up the crosshair automatically, or you can hit Control F, or you can manually click it. When you use your crosshair, you're measuring areas. So right there, you see 11, which is the candle count. Right here, 11. So let me count these candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. All right, so candle count. What else do you have? You have 2,126. That number is depicting the amount of pips, and it's giving it to you in micros. So what it really says is 212.6 pips. All right, so that's 2,126 micros, or 212.6 pips, and the current price of my crosshair is 150.846. Now, let's do it again right here. Right here, we're measuring from 148.437. Look at the right side of your screen. That is your price, where you're starting. And then we're going all the way to 151.111. So from 148.437 to 151.111 is 2,674 micros, or 267.4 pips. Remember, move that decimal point. Don't get that confused. Then we have our line tools for your trend lines, which you will eventually learn. Stuff like this. Okay, and then you have your horizontal lines, which you'll be using to market for Kazis, which we've covered on session, but we're going to cover it again. All right, Kazis and important price points. So stuff like this. All right, and we move on. Rectangle tool, which is what you use for market structure when you're learning to train your eye, which you guys see me mark up in some of the videos with simple boxes like that on the lower frame. So here, for example, on the M15, what would I have done? Well, there's an obvious lower frame area. Let me go to each one real quick. Right here, and then the next structural area is right here, and then after that, right here. So, what you want to do when you're marking up a chart, which we are going to cover, but I'm going through this real quick. When you're marking up a chart, you want to find out your areas of struggle or areas of interest. Right? Areas of struggle or areas of interest. If I'm coming on a downtrend, I want to look for the area. I want to expect certain struggle areas. For example, if I was coming down here, I know that here is the first time that I came up. Tried it again, lower low, still holding strong, EMAs, I'm still holding. This area is still a buyer's zone. And anybody who's coming on a downtrend found out quickly, no good, right? Now, if I'm marking this up correctly, this price was expected. I go to my higher frame. One of the areas you had to mark up, boom. There you are. All right, right on the Kazi. Right, that area was expected. You were expected to tap this area. 1 Kazi, 2 Kazis, right? You were expected to hit this area and for it to struggle there. All right, so if you were on the uptrend, once you got here, you knew you were in that danger zone, that seller zone. Right? You knew you were going to have a problem there. We're going to go over this again, and we went over it on session. We will go over it ad nauseum during our sessions because this is what you're going to be learning. How to structure your trades correctly. How to mark up your chart correctly so that when you're trading, not only can you get in for the wins, but if you're losing on that trade, you can trust your analysis and get out so that you don't have to let the trade run for too long. Now we come to the important part of your most important part of your analysis, the charts. Now, in some of the older videos, I used to cover all the way up to the M1 because I firmly believe that all the frames are basically the same thing, running in the same fashion with channels and highs and lows. The only difference is the size of the volume. So if you know how to use your frames correctly, from the monthly all the way to the M1, if you know what you should be doing on them, right? You don't take a knife to a gunfight. If you figure out what weapon or chart time frame is best for what situation, you will be more profitable. So let's go through them. For the beginners, you have monthly, weekly, daily, H4, H1, M30, M15, M5, and M1. What it means is on the monthly, every candle on the monthly chart is 1 month. So this chart is showing you a crazy amount of pips on your screen because the price is going from 123.950 all the way to 250.154. We haven't been up here since 1998 and over here since 1991. So we work mostly in the weekly, daily, H4, H1, and occasional M15. Anything past that is a little bit of overkill. In your sessions, you're going to hear me talk about the weekly, the daily, the H4, the H1, and the M15. M1, M5, M30 monthly, I don't really use that much. Every once in a while, I'll look at the monthly, but honestly, that's once a month. Now let's bring some things into perspective. I'm going to change this real quick with no indicators. Why do we use the weekly chart? Well, we use the weekly chart. We start from a higher frame because the information on the screen is true and tested information. It's been tested over time. Every candle on your weekly chart is 1 week. This little candle right here is 1 week. So I'm going to take this candle and a little chunk of that candle. I'm going to fill this in so that you can see it on the lower frame. All right. Now, listen to this carefully. You want to chart from your higher frame because that information is the real info where the money is at, where the market makers are picking the market, where the banks are entering the market, where you have top tier retail traders entering the market. They're not really trading that middle market stuff that's not really going anywhere. A profitable trader waits for real confirmation. Real confirmation comes from those strong areas. And when you start getting your trades in those strong areas, your trades will actually have some giddy up. They'll move. You'll catch pips much faster. There'll be a lot more taking profit situations. You'll find out pretty quickly whether you're right or wrong, which is what you want. You don't want to suffer through a trade and then you're in a negative 50, 60 pip trade wondering if it's ever going to break back, and you just keep making it worse and worse and worse. You want to find out quickly. So the weekly, the daily, the H4, the M1, and the M15. Side note, you'll find that I repeat myself a lot because this is a game of repetition. If you don't like repeating yourself and repeating your actions, you're in the wrong game. So weekly, let's highlight this real quick. We bring it down to the daily. Obviously, way more candles in our highlighted zone. A range of 318 pips. 318 pips in this highlighted zone. We bring it down to the H4. We start to see even more candles and, more importantly, more upticks and downtrends inside of this market. More waves, right? Up and down, up and down, up and down, up and down, up and down. H1, even more waves. You're seeing the noise of the market. You're seeing the details. You're seeing these white filled-in candle downtrends. You're seeing these empty hollow green candles uptrends. You're seeing all the little moves that happen within the market. You're starting to see these little spaces in the market where things are becoming important. All right, that may not be that visible on the weekly chart. Right, that may not be that visible on the daily. Maybe the H4, you start to see it a little clearer. H1, you start to see it even clearer. Right? How about this? Right, the trade that happened just now on a Friday. Right, you start to see the weakness of this market in this area, especially on an M15. Let me squeeze this up a little bit because we got way more candles here. You start to see that every time the market tried to pull a downtrend, it's dying here. This is your retracement level. This is where the market is dying. This is your retracement level. This is where the market is dying. You're starting to see that more and more as you work through this market. Right? This is the breakout point of this trade. Boom, right there. And we just died here. There's no movement whatsoever in this zone. Every time we got down here, death. It wasn't trying to break out. Even when it tried right here, nothing. Until finally, a breakover. So my point is, when you work from the weekly daily H4 to the H1 to the M15, from top to bottom, you are seeing the clean information on the weekly daily H4, and then you're seeing your timing on the H1 M15. You're seeing the noise of the market on the H1 M15. What that means is you get to see these nice moves, right? Because you trust this area on the H4. When I go to an H4 chart, let me clean this up for you. When I go to an H4 chart, and I can just cleanly see, you know what? That's a support zone. Maybe I add a nice little EMA. Hold on. The EMAs, trend line. Maybe I see my markups, the way they're working. See these markups right here? You have to mark this up. If you were on session, you know that. So if we check it out on a daily, first thing we see on that particular situation is you'd be a maniac after this day closed to take a downtrend anywhere further than here, because the body of this candle on this massive wick, let's zoom it in, on this massive wick shows uptrend power. They tried to bring this market down, right here. They tried 90 pips. Actually, it went 120 pips. And as soon as it got down, this is the same day. This is London to New York. The market shoots up 159 pips. So there's nothing sauce on that one. You cannot try a downtrend here. Not past this place. This is where the market actually broke out from this high. Now, if you don't see it, that's why I provided you training tools to help you see it. Remember, you look left to mark up your chart. Boom. You do this on the weekly, the daily, and the H4. There you go. These Kazis are here for you to see these important prices in the history of the market. 1, 2, and then eventually 3. They're there for you. I provided them for you. A way for you to see the market cleanly, right? So when the market tried the downtrend once, twice, 3 times over 3 sessions, nothing. And then New York news hit, boom, 100 pips. That's how you trade. Marking up your charts and being smart about where the power of the market really is, where the best entries really are, best prices for you to target. Now, I got ahead of myself a little bit, but you've already seen this, so we're gonna go and skip around, but we're gonna make sure we cover everything. Let's mark up a chart. We start from the weekly, right? As you were told on session. We start from the weekly. And first thing you do is you look for your strong indicators. Now, first, before we start marking up, we need to know what's what. On your charts, on any chart, you have indicators. Now, your indicators, they are not magic system tools that are going to tell you exactly what to do each and every single time. Your indicators, they are not going to do this for you and enter the market. You're not a monkey that responds to an arrow and a light and a whistle, and then all of a sudden you click in and you profit. That's not how any of this works. Here's the funny part. Indicators are based on price action. They read the volume of the market, they read the candles, and then they execute whatever the programming in that indicator is, whether it's formulate a little box or formulate a little red square or tick on the, move the line a little bit or pop an arrow, whatever it may be. That's what indicators do, right? They read the price action of the market, they read the amount of steps on the candles, and then they trigger the indicator. You can do the same thing with your eyes, and you can see it way before the indicator even does it, because indicators are inherently slower than you. And if you don't understand why you're doing something, why you're investing your money in something, then would you do that with would you allow someone to invest your dollar without any understanding of why they're doing it? The answer is no. If you hired someone to invest money into the market and they couldn't explain their losses, or they couldn't explain to you why they invested that money, you would fire them in a second. So many of you would need to fire yourselves from being traders. So here in this course, we're going to focus on the real nitty-gritty of what it is to trade, how to see the market from a technical point of view, a fundamental point of view, and recognize market conditions using the details on your screen, which is the candles. Nothing on your screen is more important than your candles. Your candles are running that show, man. They are telling you what to do. And even if you follow the candles to a T and you lose, never stray away from it, because every now and then the market is getting manipulated. Every now and then you may read the market wrong, but every now and then is not all the time. Something that I say on every student's first session is, you are going to lose. People hate to hear that, but the truth is that everybody loses. No matter how many screenshots you see on the internet, no matter how many times someone says that they win every trade, they never lose, it's BS. Listen, everybody loses. You know how you know that? Because banks lose, hedge funds lose. They have to stick to certain parameters to make sure that their losses are not too big and their wins are maximized. That's the game. The game is to win as big as you can and to minimize your losses, right? The game is to never let your losses get out of control and cancel out a series of wins. Many people, they do the opposite of that. They lose like champions, right? They can hold a trade for 3 days in the negative. The winning, on the other hand, that's the thing that they cut out and nickel and dime the market as fast as they can. So we got rules for that. But first, we got to cover the indicators. So on your screen, you have supply and demand zone, indicators that show you areas of interest in the market, areas where the market came to. Let's go to a frame with some noise on it. Where the market got there and automatically either struggled or pushed away strong, right? So got here, pushed away strong, got here, pushed away strong, got here, pushed away strong. Now, it's a support and resistance indicator to help you see the market a little better. My goal with the system that I created was simply, I wanted people to be able to mark up a chart and see the market correctly, to actually pay attention to those details and know where to look. Because if I clean up this chart with nothing on it, this does not look like anything that anyone can recognize. Now, a trained eye might see this, but other than that, there's a lot of other areas here that are tough to see. You see a lot of peaks and valleys. You don't know where to start. You don't know how to get going. Everything kind of looks the same. So I figured out a way to train people's eyes. So every single indicator on here is trying to teach you something. It's trying to teach you better targeting on price. It's trying to teach you exactly where to look. It's trying to teach you how to adjust your mindset in specific areas. It's teaching you that if you're on a specific trend and you get to a certain target, it's time to start thinking about taking profit, cutting the trade, maybe pushing the stop loss a little bit. It's trying to teach you something. So by the end of this, as you become a better trader and time goes on, you can choose to use a naked chart like I do. I use a very naked chart with very little indicators. I like having a clean screen, right? I like having stuff like this. Like I called this out inside of the one of the telegrams that I'm a part of. Right? I like doing things like that. That is the type of trader that I am. All right. Now on one screen I have something like this. On my other screen I have the template that I provide you guys. It's your choice. Some of my most successful student stories, they use a naked chart now because their eyes have been trained in a way where they see the market in levels, they see the market in price blocks, they see the market in moving trend lines like the EMAs. So they see the market how it's supposed to be seen. They target price because they've seen this dance many times before. Other people, they never drop the template because they enjoy the easier view of the market. They understand what to look at, and they maybe remove some EMAs, they maybe remove some of the Kazis, change the colors around, mess around with stuff like that, but inherently it's the same thing, right? Back to the template. Okay. So, supply and demand zones, the gray boxes. And then you have the red and the green boxes, which is the Kazi, K-A-Z-I. Now, that is not my indicator, but when I bought the indicator, basically, it was supposed to be this indicator that as soon as it created a Kazi, it was an automatic entry. The Kazi, they pop up on their own. Well, that's one of the questions that I get the most. Do you have to do anything with them? No, they create on their own. How they create, very similar to the areas of supply and demand. It's areas in the market of monstrous interest, where the market was either teetering there for a while or had some sort of breakout, which is still interest because no matter what, in order for the market to move either through something or away from something, money and volume had to be pushed up a notch, right? So what that means is as soon as we got here and we pushed up, the buying power increased exponentially. As soon as we got here and it pushed down, the selling power increased. Buying power, selling power. How we know it's selling power? Check it out. It came all the way down and retested this area. Look, this was my floor on this week. And then this same area, just like that. What did it do? It shot all the way down. They brought it back, and selling power continued all the way back down. Notice this area right here. Okay, you had some buying power that made this market struggle, right? We're selling. Oh, something's freezing this. We're struggling here. Right back up. What happened after weeks later? And then selling power all the way. All right. The market is structured in these blocks. This is a weekly chart right now, and we could do this on a weekly, looking at big monstrous moves, or we could do it on a N15, looking at 20, 30, 40 pip moves, looking at the small structure of the market. It doesn't matter. They all run the same way. Something that I like to say to students is, in order for the bigger moves to happen, there has to be structural happenings on every smaller frame. The larger the move, the bigger the frame, the longer it has to take. So those moves take a while, but once they get there, you're gone and you're going to make some pips. So what we do is we use the beauty of the higher frame, and then we use the beauty of the lower frame, and in tandem it makes it much easier for you to pick and choose what kind of trader you want to be. So we have the Kazis. Now, how do we use them? How do we use the Kazis? Now, I got to repeat this one more time for the newer people. Whoops. For the newer people, indicators are created. They do their own thing. Once you install them, they're going to pop. They're going to create, they're going to print, or as you know, my Brooklynese, they're going to pop. And basically what that means is you don't have to do anything. You don't have to worry about it. Once we install them, you're good to go. pardon this thing being messy. I think it's still lag on the system, but we're still going to be able to do what we got to do. So let's start with the Kazis and the supply and demand zones, right? Because they pretty much go hand in hand, other than slight little detail switch. All right, so here I made them the same color, but just for the sake of the video, I'm going to swap the color real quick. All right. Now, first questions I get, like I said before, do I have to do anything for them to create? No, you don't. When I first got the indicator, they were supposed to be a magic way to enter the market. That was in the beginning of me searching for the magic system, and there was none. So the indicator, when I purchased it, it was supposed to be this magical thing. Well, guess what? It repaints. So after the fact, it looks really magical. But it doesn't repaint if it's established. So, for example, here, this happened back in 2013, or even this one that happened this week. These that happened this week, or this one, these are going to be here forever. They're not going anywhere until they scale out of the chart because so much time has passed by. But they're not going anywhere. You don't have to do anything. They're going to be here. So again, the Kazis are showing you price interest, areas that you should be paying attention to when price gets back there. Because the market moves in this up and down fashion, and you just need to know, hey, am I in an area of interest? Am I in a zone where a lot of buying or selling has happened before? Am I in an area that was once a seller zone and we've gone through it and now we may be in an all-out buy? You need to recognize these things. And how you do that is your Kazis, is your supply and demand zones, your trend lines. All those indicators are helping you determine what's happening here, the size of the candles, things like that. Now, as much as I would love for every detail of every single type of trade to be determined in one video, that's not the way this works. Again, I say you have to trade. You have to get in the market. You have to experience. You have to see. This is a skill. And I could tell you how to ride a bike all day. I can show you videos. I can break down all the little pieces of bikes, and we can build a bike from scratch. But until you don't get on that bike and scrape your knee a couple of times and crash into the wall, and I don't hold the back of your bike and make you pedal and make you believe like I'm holding the back of your bike and you're going to be safe, until we don't do that whole process, you're never going to learn how to ride a bike. So here what we do is we break down the pieces, right? What makes up the bike? What makes up the market? Right? What are we looking for? How do you go about it? How do I go about it? What do the indicators do? What are the pieces of the bike? And then we scratch our knees. We scrape our elbows. We give ourselves concussions on demo. So it doesn't really hurt that bad. Right? You're on demo. You're training and you're trading on demo for a couple of days, couple of weeks. And then you start to see some consistency. And then you realize, you know what? I can do this. I can mark up a chart. My markups are actually pretty good. I am catching 20 pips in a trade. When I do lose, I went against my rules. Or maybe it was just one of those things. News hit, something happened, I didn't react fast enough. Different things that happen to new traders. Or just good old losing. So we need to know what things do and how they work. The Kazis are meant to be marked up on the higher frame. On the lower frame, the purpose that they serve is they're showing you the smaller structure. So sort of how here we see these highs and we see these lows. On M15, it's showing you the same thing. Now, most of your charts for beginners, I remove them from the M15 and I leave them on the H1, H4 daily, weekly, because some of you won't ever see the M15 depending on the type of person you are. If you're overly aggressive, the M15 does not serve you a purpose because you're going to think that everything is a opportunity. So we start on the weekly, and what we do is we mark it up. We look left. We look left because everything on the left is the history of our market. And on this weekly, we go all the way back to 2013. I don't know about you, but if I want to invest my money into something, I want to make sure that that stuff has held true over time. If I was going to open up a franchise, I want to know that this franchise is not some fly-by-night company that's giving me a business model that's destined to fail. I want to see other winners in this franchise model. Show me other businesses that have opened with the same model. So with this, We want to use information that has held true and has done similar activities as what we're trying to do. So we look left. This is a weekly chart. We are currently here, right? We're an area of supply and demand. We had a strong downtrend that got pretty much halted. Okay, we are actually currently in a very strong, right here. If you look at it, right here, an area of struggle, price interest. We are currently in a strong price point. But anyways, we've been uptrending. All right, for the last couple of weeks, we've been uptrending. Every time we try to go up, it would come down. Go up, it would come down, but just a little higher. It would come down and create a higher low. All right, and it would create a higher high, meaning bullish power. But what we do is we take our little line and we start marking up key areas, key kazis, because the kazis are showing us key price points in the history of the market, areas of interest. And we mark up on the weekly. Now, we don't mark up all the way up here, because if we do that, we are literally, why are you worrying about what's up here when this is thousands of pips away? Thousands of pips away. We haven't been up here since 2015, 6/28, 2015. We're not getting up there anytime soon unless something drastic happens in the world, because news moves markets. All right, if something drastic happens, then you can see something ridiculous. But for normal everyday movement, you're going to get every week, what, 200-300 pips, something like that. So mark up what's near you. Worry about what's near you. What else do we have in detail-wise? We have area of supply and demand. We have, if you go to a lower frame, we're going to see this part, and then we have this high. So everything's been pretty much marked up. We go to a daily. Now this is what we're working with right now. This stuff. I'm going to actually go back to the weekly and place a little line just so that we can remember our spot. We're working with this stuff right here. We go to the daily, and we're going to do the same thing. Now, we're going to mark up the clusters of the market. So we got this one right here, which is 1, 2, and 3. And then we have somewhere in here, 1, 2, 1, 2, and then over here, okay? And we have, because we are currently here, this is a gang of lines. There's a crap ton of lines right now because I'm trying to mark up all this stuff to show you guys. But if I was over here somewhere, I'm not worried about this crap down here right now. I'm worried about my current high, my most recent low, and pretty much this zone. Especially for new traders. New traders, look, from here to here, you have almost 600 pips. A new trader is going for 20 pips. Remember that little example I did with the fill-in where I showed you all those ups and downs? The reason that we use the daily frame is because we can see our most keyest of structures, and we're looking for 20 pips on those either pushaways or breakouts or continuations. 20 pips. So I'm marking it up just for the sake of showing you how this works and that it works. But when you are trading, let's say you were up here, you would only have lines here, 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 and here. The rest of this crap doesn't matter to you right now. H4. Now, if I mark up more lines here, it's going to be overkill. But if you were just worrying about this area, then you can mark up, additional areas of cluster if you want. But my point is very simple. Look at the way the market works, right? From our Kazi perspective, from the lines that we've drawn, you can actually see how this market has. Everything I marked up was before the line. So everything that I marked up was stuff over here, right? Like this one, okay? Like this one. It's before in the past. And look how it applies to everything after the line. We go to the H4. Now, starting here on this downtrend. Actually, you know what? Let's just start here. First things first, that low, this high. It happened here. Remember the H4, we would mark it up also if we were somewhere in this zone. Look how this worked. Kazi line right here on 209. Guess what? They came back here On 221, drop. Kazi cluster right here. Uptrend. 100 pips. It looks small. It's 100 pips. You're looking for 20. You're looking for 20. Somewhere in here you're getting 20 because you're a beginner trader and you have to start from, you have to decide whether you want to be a 20, 30, 40 pip trader or a 100 pip trader or a 200 pip trader. That's really up to you. But at the end of the day, the way you take the trade is the same way. Areas of interest, areas with real market volume. All right. So once we broke under, guess what happened? Once we broke under this cluster, guess what happened? Boom. Strong trade. Goes low, goes low, goes low, goes low, goes low. Done. Market comes all the way back up to where? There's that good old Kazi. This is still the H4. This is still considered a higher frame. Downtrend. 156 pips. Market struggles in this area. Downtrend. Still almost 100 pips. Market comes back. Uptrend. To where? There's the line from the past that we marked up. Somewhere in the daily, this was holding. Downtrend. Back to this area. I'm showing you how the market works in the same prices over and over. Uptrend. Back to this area. Downtrend. Back to this area. Lower and lower and lower and lower we go until finally we get not even that close, but pretty close to this zone. Away by 18 little pips. Now the reason we use the H1, I'm going to give this a little empty markup so we can go to the H1. The point of the Kazi is to show you structural areas of interest. Price. The bigger areas and the smaller areas. Notice that the Kazis on the daily, the weekly, the H4, they're not the same. They're in different zones because the Kazi is taking the different candles and deciding where it wants to put those lines. So the point for you, the Kazi, so the point for you is you are training your eye to see your structure on the weekly and the daily. Bigger picture stuff, stuff that's going to work for a week or a couple of days. And then on the H4, the H1, what we got to do today and tomorrow. What we got to do this session. Right? The lower the frame, the smaller the move, the more right now the information, how fast you can apply it. So if you actually go weekly, daily, H4, and you look at the bigger picture of the market, and then you go to the H1 and the M15 and you take your more precise entries, 20 pips, 30, 40 pips, you know how fast those are going to come? We're going to do it in a second. Then we had this area. Remember this price? Back here once again. Boom. All right. Then we had this area. Back here once again. Notice the moves are much stronger from these zones. And finally Friday's area, which is this one, which applied to all this. Right. And even if I go over here, my H4 real quick. Boom. Guess what? Uptrend. All right, look at the wick. Look at how this thing wicked off. This just happened. It wicked off between here and here. Not a coincidence. Not a coincidence that you have that much space there. It's not a coincidence. There's no such thing as coincidences in trading. So what's the other positive thing of learning this way? You get to see all the moves. A lot of the times traders get stuck in this bias. I'm going buy because I'm going for a long or a buy, a bullish market. All means buy. To buy, to go long, bullish market, up. To sell, to go short, bearish market, down. All right. A lot of the times what traders do is they'll look at the weekly chart, they'll look at the daily chart, and they see just uptrend, right? They're like, I'm buying. But then when they go to buy, they'll buy from up here. They'll buy from up here, 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 here. All the places where this thing would have gone painfully wrong. They'll buy from up here, right? Maybe turn this into a really bad loss. Or up here, well, look at this. This looks like a buy all the way. Boom. And then 127 pips of downtrend. They're buying all the way, 60 pips negative, and then finally it goes their way. They buy from, let's say, up here, 30 pips positive, and then all of a sudden, loss. You gotta see your structure on every frame. That's the key. You gotta know where you're at. Because if I go to a higher frame, I can see that this area is no joke. Right? We've been here before. I can see all these little dips and I can expect that, you know what? Maybe it's not a good decision to buy from here. Like this area right here. Let's clean this up. By the way, at this point in the video, you should understand how to mark it up. If you don't, write it on your notes, and then when the next session comes, have me go through it with you again. How do we mark up our horizontal prices? Let me throw this in here. When you mark up your horizontal price with the Kazi system, you're not going to get every single detail in the market. This is the beginning way of doing it. Eventually, your eyes will see it. Your eyes will see it. If you're part of the Telegram channel that I'm in, you see those naked charts and you wonder, how the hell did he see that detail? Years of doing this. So, and honestly, it takes a while to pick up on those details, to pick up on these wicks, right? To pick up on the weakness, the seller's weakness in this area, to see this zone right here, and to know that in order for this sell to hold, we can't get up here. We can't. We have to stop somewhere in this area. If we get too high, if we get past this point, we're going to get up here. It's going to be another 40 pips, not worth the hold. So if you, at this point, do not understand how to mark up the Kazis, that you're looking at the left side of your screen on the weekly, daily, and H4, you do not mark them up on the H1M15. You use your eyes for this stuff. H1M15, you want to use your eyes, right? If this was my high at some point in this market, this was my high. When this market started, it started going up and up and up. Look where I'm struggling. I'm struggling in this similar zone. I'm struggling. And then I'm over it. If you're trying to take a sell here, you got to realize, look, I'm over it. That's it. It's going higher. I got to cut this. It's not worth the hold. And eventually it goes 43 pips negative to turn you into a positive. You can't tell yourself, oh, I was just early. No, you didn't let go of the trade. You cannot allow the market to scale this back on you, because the same mentality would have screwed you on the following series. Let's say you tried the same thing, right? Where you're like, oh, it's going to just come back. So let's say you started from here this time because this was the high. Oh, it's going to come back. No, it's going to come back. Yeah, 63 pips later. And then it comes back down for positive 10. And you're like, oh, this is where it's going to hit this low. And then it's just holding and holding and holding and holding and holding until finally you turn this into a blown account. Right? Knowing where you're structurally at on the bigger frame and the smaller frame is how you're going to learn to murder the markets. You're going to learn to get in and get out with real data instead of just your feelings and emotions and all the other squishy crap that people bring into this realm. This is not a place for emotions. This is a place for data and logical, data-filled, historically based decision making. That is what you're doing. So in this particular example, when the market just stalls here, well, let me just clean this up. When the market just stalls here, you got to tell yourself, okay, this was once my high. Then I struggled in this area and I broke over. After that, hey, listen, I got to take a buy here. Not only that, my daily candle, look at my a wick, monstrous wick. What does a wick mean? It means that as this market was coming down with selling power, there was so much buying power that it just shot it right back up. You got higher lows being created, buying power. You're a maniac if you try to take a sell in this particular situation from down here. Now remember, in session I tell you this. Everybody loves the cliche saying of trend is your friend, trend is your friend. They see a buy, I got to get it in a buy. They see a sell, I got to get it in a sell. But where you get in from is what matters. Because if I'm trying to take a sell, I could have survived taking a sell 30 pips, 60 pips, which I did, posted in the Telegram, 58 pips, 30 pips until because I'm taking it from the highest point, right? Smart trading, taking it from the highest point, even if I took it from here, from this higher point. Right? I'm trying to survive. I have a survivable trade. I can think a little bit. This is an H1 chart. Hours are passing in between these trades until finally I start creeping over. What do? Cut the trade. Cut the trade. That's what you do. You cut the trade. If you're selling and selling and selling and seeing the market wrong, you still were able to profit. Cut the trade. Now, if you were buying, which was the right thing to do, you're seeing all that buying power, that daily candle, higher lows, all that good stuff. And then we get to this support zone, this buyer zone. It was once our high, and now it became our low of the market. What was once resistance becomes support. What was once a ceiling becomes a floor. And right there, boom, 120 pips. Structurally, where we are at in this market, we are in a critical seller's zone. How we open Sunday into Monday into Tuesday is going to be important. All right, tons of wicks in this area, tons of selling power, a lot of selling power in this zone. The last time we were here, what happened? Last time we were anywhere here, we had a monstrous sell right here. Boom, 650 pips. This zone, this area, these little details are telling us something on the daily chart. Clean, big trades. It's saying something. It's saying, hey, if I break over and start curling up, don't you dare take a sell. Not until you get to a higher point. If I start coming down, we're probably going down for a while. When you bring it to a lower frame, what does it say? The zone again. If we break under, probably got more downtrend to go. Right? If we break under here, we start breaking these old lows. We got some downtrend power, right? That's how you determine the market. Now, this is just a refresher video. This is not meant to teach you everything in one video, but I want you to start seeing things. I want you to start hearing the terminology and understanding. Now, a lot of times people freak out. It's week 1, week 2, and they don't know how to get into the market. They're confused. They're all over the place, right? They send me messages like, is this this? Is this that? How do I get in? Get in. Put some skin in the game. You're on demo, baby. Doesn't matter, right? Because what teaches you how to trade is not videos and my lovely voice and, great PDFs and markups. What teaches you how to trade is trading. Now, only a dummy goes live with that understanding. But on a demo account, you're trying it out. You're trying to follow the rules that I'm going to provide you at the end of this video. You're trying to follow the rules with the indicators and mark up your chart and learn how these things work. That's what you want to do. You want to learn how to maneuver in the market. The beauty of trading is you could be on demo for as long as you want. Right? You could trade on demo and learn and solidify your skill for as long as you want. Right? And then when you're ready, you go live. That's it. So if right now at this point you're like, I still don't understand. I'm still not an expert trader. You're not supposed to be. This is a refresher video. We got sessions ahead of us. You can hit me up anytime. Right? You can hit me up on Facebook, on Telegram. Don't hit me up on Instagram because they don't have voice recordings and I hate that. So make sure that wherever you contact me, it has voice recordings. But anyways, this was the structural part. Using the Kazis and the supply and demand zones to determine whether or not you're in a structural area of interest. If you're on a higher frame, that's the bigger stuff. The areas of interest are way stronger, right? Bigger pushes. And as it breaks those structural areas, as you start to determine those areas better and better, you're going to become that much better of a trader. You're going to be able to see this stuff with your eyes half closed because you got to kind of look at it. Stuff like that. You're going to see it real nice, real clean. The best areas to get in the market. All right. Now, the market works with horizontal price, obviously, which is just what we covered. We covered the side-to-side stuff. Those nice little lines that we determine are key price points. Now, key price zones, which is more important. And you'll learn that I would rather you look at the market in a zone mentality, right? In a specific price cluster. When you look at exact prices, it's usually never good because you're trying to be a perfectionist. If you look at it in a zone mentality, it's going to offer you a little more. Okay? Now, not only does the market work in these horizontal ways, but it also works in a diagonal way, right? The trend effect. When the market starts trending, what do you do? When the market is going, it's giddying up, it's leaving me, it's leaving the train station. What do you do? What the hell am I going to do? It left, right? It left my key area. I was sleeping. I was in the bathroom. I was making dinner. These are all the things that have happened to me. I was taking my kids to school and it left. I lost my phone. I was in the Bahamas. I was on a cruise and they didn't have Wi-Fi. Okay, it left. What do I do? How do I get in the market as it's going up, 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 or down, down, down? By the way, we've been doing a lot of uptrending stuff here because the market has been uptrending. So I just use whatever was in front of me. This stuff works. Uptrend, downtrend, consolidation market. It works. Learning structure, super key. Targeting price, super key. So if the market leaves me, what do I do? I like to refer to that as middle market stuff. Middle market. It's not the best entries, but the trades are still good. If the market's already trending and you're still trying to take 100 pips, you, my friend, are going to be waiting, right? Once it's going, right? But if you're someone who understands, listen, this is an entry that maybe gives me 30, 40, 50 pips to my target, and that's what you're going to take, great. Still a great trade. A great trade is built upon data and profits, right? Whether that profit is 20 pips, 30 pips, 40 pips, or a million pips, doesn't matter. A good trade is a good trade. So what do we use for the diagonal market? We use EMAs. Now, when I show people the EMAs, they lose their crap. They get all nervous. All they see is these lines, especially if the trader's been around. Now, a lot of the times when a trader that's been around contacts me, their biggest problem is their entries and losing their money, right? They'll make some money, lose their money. Make some money, lose their money. The problem is that they don't see the structural integrity of the market. They just, when they're losing, they're not going to cut that trade unless that account goes to zero or goes to a number where they've just lost like half or more of their account. Right? It's an ugly situation. That's the only thing that's going to get them out of there. So what I've formulated is a way for you to see the diagonal market. Now, somebody who's more advanced, they start drawing trend lines. Right? They start seeing the market in this very trend effect. Sort of like here, this is a smaller frame trend line. This is the M15. Hold on as I mark this up for you. Right? They start to see the market in a very, once you start to see the market in these channels and you start to see that the market moves in diagonal fashion, creating higher highs and lower lows, and then you start to see the similarities between prices. Kazi over here, left side of your screen, boom. All right, and then all this stuff starts lining up, boom, there's your trade. All right, once you start to see things like that, this stuff starts making a whole lot more sense. But in the beginning, you need to start training your eyes. So I came up with an EMA moving average system, these squiggly trend lines. These lines, these squiggly trend lines. Look at the M15. Okay, look at the M15. I drew this trend line for you. What do you see here? You see EMAs, the squiggly trend lines, just like that. If I go to the daily, the H4, you see this EMA kind of scaling around. The EMAs are moving lines of support and resistance. They are squiggly trend lines. I don't want you drawing on when you first get started. You have enough to worry about. You got enough stuff swirling in that mind of yours. You got enough things going on, man. So I want to limit the amount of marking up that you have to do. That's why I came up with this style system. I'm trying to train you to get muscle memory in this. Visual muscle memory where you see things as they're playing out. You know where to look, how to look, what makes sense, what doesn't make sense, what to do, what not to do, and you know how to get in and how to get out. The only way to do that is to see the structural market, to see all the little pieces that are being put together. So diagonal is important. Now, the EMAs are best used in a trending market. Now, how they're used, that's the part you got to pay most attention to. All right, so in some of the older videos, you see a lot more EMAs because back in the day, I wanted to teach people how to see everything in the market. I wanted to show people that there was a point of the market where your trade was still good for one trend, and there was a point in the market where your trade was no longer good, and now we were entering a whole different plane. Okay, that's what I wanted. Eventually, I decided, you know what? I knew that as students grew, what was going to happen was we would trim down their indicators. We would slim down the template until eventually they had basically no indicators, very minimal indicators, or a naked chart. So what I started to do is I started to start them here with an area that I refer to as home base, which is EMA 10, EMA 20, home base, which is EMA 10, and then the pullback zone, which is EMA 20, 34, and 50. Home base, EMA 10, pullback zone, EMA 20, pullback zone, EMA 34, pullback zone, EMA 50. Now, I gave them those very creative names, if I must say so myself, because I wanted people to understand what was going on in those zones, right? When the market was trending. What's going on is you got actual channels being formed, right? So it would be in one channel. This is a weekly chart. So these little candles are actually hundreds of pips, by the way. So on this home base area, the market would go up, come back down, go up, come back down, go up, come back down, go up, come back down. Now, why did I choose EMAs? Because they're slow. They're not repainting. They're not all over the place. They're nice and slow and steady, and they're great for learning. So as you're in these areas, you know your uptrend is still good, right? All you have to figure out is structurally, where's my best areas to get in from? And when you have confluence between EMAs and your structure, you're still good. Example, this trade. All right, this is the EMA 10 on the H4. Right, what ended up happening was structurally, we were somewhere here. Those boxes that we're just painting, it kept interacting with your EMA 10. You're still within your EMA 10 and pullback zone. Structurally, you're something like here. All right, so you're still good and your uptrend is still alive. So to take a sell, you're a maniac. Right, this whole zone is an uptrend zone up until you get under it, or you get under your key area, in which case we're coming down a little more. Enough that you should not be taking a buy because you're going to take a hit. Now, does that mean that it's going to just tank? No. Remember, a trade and a trend goes through all different levels of structure, and you got to figure out which ones are being broken. Now, if you break a daily or a weekly structure point, something like here, then yes, you are going to go a lot lower than your account can hold. All right, you are probably going to target somewhere in this particular zone, which is about 80-something pips, which nobody should be taking that type of hit. So EMAs are moving lines of support and resistance. On every frame, they are different. Why? Because on the weekly and the daily, they're calculating much bigger candles, bigger moves. On the M15, smaller moves. Now, I haven't really talked about the M15 a lot. The M15 is basically a targeting frame, price targeting. When you are trading, your goal is to figure out the zone where you want to get in from, whether it's a continuation zone or the ultimate retracement zone, meaning it's like the high or the low of the day, or a buyer zone, meaning like something like here, or a seller zone, which is somewhere up here, wherever it is, and get as close as possible to the price. What people do is they'll figure out structurally what they want, but they don't wait for the price. You know, like let's say, for example, something simple here. This area right here. Oh, nice. This was my low at 405, 1430 GMT. We come back here and we go negative maybe 8 pips. Who cares? And then we go positive 34 pips. And then eventually that entry goes positive 121 pips total. Okay? Now here's the funny part. What a lot of people do is this. Once the market is already trending, right? Once the market is already going, so something like here, like we started here and the market's down up 19 pips, they'll take the entry. And then 20 pip negative. Most people, that's a cut. They're scared crapless by this one little drop, 20 pips negative. Their mistake is they know that this was the last low. This was the last low. This was the last low. They know that, but they get in up here. Big mistake. They see the EMAs above them, which is a form of a trend line, a form of resistance. Above, they're in your way. Below, they're nestling you to continue yourself up. They see these things and they still ignore them. The point of trading is to get the best price possible for your situation. If you want to take a buy, you let the market come as low as logically possible so that you can take a buy. If you want to take a sell, you let the market come up as logically possible so that you can take a sell. All right? So what ends up happening? If that person got in at the high because they're reacting to the way this market worked, they got taken out and then they're licking their wounds. Okay? And then what they do is they wait for down here. They wait for this area. They're waiting and waiting, and it's never going to get there, and it's going 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 and it's gone. Then you know what they do? Once they see another form of breakout, they try it again. There's your next hit. Or maybe it's this one. There's your next hit. Or maybe it's this one. There's your next hit, because they are scared crapless. Now, if you're using the EMA methodology, at some point, this starts to make a ton of sense, right? When you see that the EMAs are starting to spread out, get unclustered, they're starting to like wave out, meaning that we're now starting to trend. And as long as you wait to get back within them, and you use the structural stuff that we spoke about in the previous part of this video, this trade was yours for at least a minimum of 20 to 30 pips. Eventually, from there, 90 pips. Now notice, market comes back into your EMAs, 30 pips. Comes back into your EMAs, 16 pips. Your trades are still kind of surviving. Now, unless you're totally blind, you don't realize that this right here, wick on the higher frame, right? If you're stuck on the lower frame, you're not seeing this stuff. As you go to the higher frame, you start to see downtrend candle. You got to stop selling. You also broke that area and you're under it now. So you're expecting a new low to be created, or at least to match the old low. You're expecting something like that. You gotta get a little more patient here. Now notice we got lower than prior moves. 19 pips. I want you to notice something. It was playing around in that EMA 10. Then it was playing around in that EMA 20. Then it's playing around in that EMA 34. What does that mean? Levels to levels, man. Structure to structure. Diagonally and horizontally. Now let's go over the EMAs again. Like I say in the sessions, there's no way to do this in any particular order, because I don't believe that trading is in any order. It's the details. You got to gather those details. Let's look at some uptrends and downtrends. Now on the daily chart, you got the same EMAs. Now obviously in some of these, it's beautiful, right? Some of these wicks were a little harsher. Why? You'll learn this in future videos. Where you start from matters. If you hit a critical area in the market, this is a critical area in the market, you have to respect how much retracement this thing can give. It's picking up a lot of selling power here. You gotta have to respect that. You have to respect that there's a lot of sellers here waiting to repeat these same moves, right? So once we got here, what happens? Boom, drop. But the buy is still good, right? It's just about where you're buying from. If we look at this, pretty even on the price. All right? And then the market continues up and up and up and up, right back down. Up and up and up and up and up, right back down. Now let's see what we could have done in this area. Right? Let's go back to January the 15th to January the 24th. Scrolling and scrolling and scrolling and scrolling. Let me minimize this real quick. We're going to get here much faster this way. All right. All right. So that uptrend that we were just talking about. This is the drop that happened harshly, right there. And then we start uptrending again. Notice how it worked. Remember, structure. This is my low. On this move right here, this is my high. Notice that we stay pretty much in that area for a while. And then my lows start getting higher and higher and higher, and then boom. How do I get into this trending market? Now, if you follow the EMA methodology on the M15 or the H1, what you do is you don't get in when the market pushes away from your EMAs, your trend lines. You get in when the market comes back to your EMAs because they are offering you an understanding of retracement, where my best zones are to get into the market to give me the highest probability possible, because we work here in a sense of probability. We try to do things that make sense with the averages. What happens the most in the market, which is up and down. So the market goes up, hits my high, comes down, hits my retracement level, my pullback zone. If you got in the EMA 10 because you jumped the gun, you're negative 14 pips, which is not enough to take you out. And then you're positive 33 pips. If you get in on the EMA 10 here, you're negative 25 pips, which is not enough to take you out because you, as a student of mine, have to have a 30 pip stop loss. From there, positive 44. From there, positive 191. All right, you tried it again here. Negative, if you got in early, which is at the high, you're negative 19 pips once you got to your EMAs. Once you're in your EMAs, you try to take that buy, 18 pips positive. Do it again, 25 pips. Do it again, 23 pips to that big move that we were just talking about. The mistake people make is that they try to get in on the momentum of the market. You have to get in on the retracements of the market. You cannot get in when something is already moving in your direction because you are late. The only time that ever applies is if you've broken new structure, right? Once this thing is already going and it's settling in a different low, then you got to take it up, right? Then it's not coming back because then it would make a new sell. Now let's try a downtrend. Down, up into the EMAs, down, up into the EMAs, down, up into the EMAs, down, up, down, up, and then we're getting weaker. Why? Because we are now back in a price that we've broken out from, this one. All right, we're still going up. We're still climbing these charts. Here's another example. Trending market, trending market. Here's a downtrend. Let's go 100 pips down, 43 pips up into your EMAs. This is a strong trending market. This is no joke, the amount of volume being pumped here. Down, up, down 40 something pips, up 40 something pips. Look at the structural integrity of this trade. This is my high, this is my high, this is my high, high over how many hours? From 205, 445 GMT to 205, 1030 GMT, messing around at the same high. If you're somebody who's jumping the gun and you get in on the downtrend of this down here, you get eaten up by the retracement and you miss the real downtrend. Right? Here's another example. The market downtrend 77 pips. You're like, yes, this thing is going to tank. There's no way it's coming back. Poop, right to the EMA 10, 39 pips. You're out. 38 pips positive. All right. You wait for it to get to the EMA 10 again. You jump the gun on this because honestly, if you look at the way this works, my high is right here. All right. And then I go here. And if I jump the gun, and if I get in here, I'm not even jumping the gun. 17 pips. They try to get me, but they didn't. 32 pips. And then I do it again. Look, same little zones. You could target there or you could target here, one or the other. Whichever one I'm fine with. If you miss this trade, I understand because you're trying to target up here. It's fine. But if you look at the way it worked, what happened? This was my high and then I settle here. 1, 2, tried the downtrend. Comes back. There you go. More downtrend action because we were doing uptrends before. This one, clear as day over 2 days right here. Boom. And then the downtrend starts. By the way, this is a 150 pip downtrend. Down 42 pips. up into the EMAs. Down 53 pips, up into the EMAs. They try to get you. You're out. Right? If you got in right at EMA 10, you're out. If you waited to hit your structural integrity, this zone and or this zone right here, the floor that was broken that caused that uptrend, if you just targeted right there, you survived 22 pips. Right? If you targeted this zone, you may have made it. Here's another series. This is why the lower frame is important. The smaller, proper price targeting. You can't do this on a daily. You can't see it on the daily. When you do this on the daily, you're waiting a lot longer, but you get the bigger moves. Since you're an intraday trader who's trying to go 20, 30, 40 pips and or 100 pips or 200 pips, you got to learn both sides of the coin. Right? You got to learn how to do them all so that you can actually pick and choose your poison. What do you want to do? For some traders that I've trained, they take my style, which is I like to long-term trade. In the middle of that long-term trade, I'm also picking apart the market with smaller moves. So I'm doubling up my profits. I'm able to take profit at the same time as I'm letting things run. That's how I like to trade. So right here, another example. This is my high. All right. If I look at the way this worked structurally, I got this area right here. And then I got this area right here. Boom. Right? Downtrend, 60 pips. Back into the EMAs, negative 17, positive 27. Back into the EMAs, positive 62. Back into the EMAs. Boom. They finally got you. It's all right. It's okay. No problem. Don't cry. Still structurally good. 82 pips. Right? The first time that they finally swapped this trend was right here. Now, if we look at the chart on the higher frame, this is why you cannot get. You always have to know. We always mark up our chart on the higher frame so that we can actually see where our zones are of interest on the higher frame while we're on the lower one putting in the work. So if we go to the H4, let's go to the daily. I need to bring this up on my screen. It's right here. On the H4, on the daily, right here, what's going on is you are actually uptrending, and the whole time that you've been downtrending, taking those 50, 60, 100 pip moves, you are basically playing around in these daily candles. Now, when the market started really downtrending, you took all that stuff, just messing around with the EMAs on the H1 and the M15, just hitting them over and over and over again. But you could never lose sight of the fact that 1, 2, and 3. Finally, that's it. That's all she wrote. Right? You were working the trends until you got to those key price points. This whole time you were downtrending this way. And then you got here again. It was time to go up. Okay? This whole time you're coming down, 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 down until you hit the EMA 50 on the daily, which is the higher the frame, the stronger the support and resistance indicator, because it's taking much bigger volume, things that are held over the history of the market. So you have to respect what it's going to take to break that area. Right? So technically, in the bigger picture, we were going up. But in the smaller picture, we were coming down. All right? So what I'm going to do is I'm going to go to a different chart. I'm going to pick a different chart. I'm going to pick this Euro USD. Now, this video is getting a little long for a refresher video, but I want to make sure I cover as many points possible, and then I do the rules. We've covered the EMAs. EMAs, one more time, just in case you were sleeping during that part of the video. EMA 10, 20, 34, 50, and 144. They are helping you pick apart the diagonal of the market. If the market is pretty consolidated, it's tough to use. You got to be more structurally sound on the horizontal, right? They're great for a trending market, and they're even better on a lower frame to see stuff like this, like EMA 144. Look at that. Boom, boom, boom. And then struggle again. Okay? EMA 144 was also important right here. The magenta one. If I take a trend line looks like this. Now check this out. By the way, I got two channels here. I got that one and this one. What do you see here that's pretty important? The market is working off that channel, that trend line. All right, working and working and working. We've hit a low. Guaranteed that if we go to a higher frame, right there, weekly, 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 weekly. Look at all this weekly holding. Go to a daily frame. Your Kazis were going to help you see this. I marked it up without the Kazi, but your Kazis were going to help you see this. You're in an area that's not trying to get broken right now. It's just not happening. So what ended up happening? We worked down, 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 down until finally today, boom, 69 pips. It's a smaller chart, less volume. Still applies. Same rules, man. Euro USD, one of my most hated pairs. It's so slow. Okay, but on the way to this targeted zone, EMAs, EMA 144, playing around in this low. That's why you get these pushes that are so strong. Always know where you are at on the lower frame. Now, if I went to the M15 and I tried, or the H1 and I tried my EMA methodology, here we go. We're downtrending, right? Down 16 pips, negative 12. From the 144, 48 pips. From the pullback zone, 45 pips. You're not going to get monstrous trades here, and then you hit that zone. That's why I don't like this pair. Let's go to another trend. Here's one. All right. Up 20 pips. Down 16. Up 15 pips. Down, I don't even know what that is. Up 16 pips. Down 27. Right? Then inside of your EMAs, negative 12, positive 23. Inside of your EMAs, negative 12, positive 25. Inside of your EMAs again, negative 12, positive 35. My point is, you will survive the inevitable retracements if you wait to get in on the EMAs. That is step one. Even if you lose on that because you misread where you were at and the amount of volume that you're getting on this retracement, the higher probability of a stronger retracement, it's okay. Learn to wait for the EMA push away. Learn to wait, whether it's, if you're on a downtrend, you obviously want the EMAs above you, right? You want them kind of giving you a ceiling to catch your price and shoot you down. If you're on an uptrend, you want the EMAs to go up. The EMAs to catch you below you so that they can help you go up, kind of cradling you up. What they are supposed to teach you is the trend effect of the market, the ups and downs that happen in price, so that when you see the market shoot up, you don't automatically get in. You wait for it to come back. You see it shoot up, you don't automatically get in. You wait for it to come back. You see it shoot up, you don't automatically get in. You wait for it to come back. Here's a downtrend example. Downtrend, where are you? This one works. It's short, but this one works. You see the market shoot down, you wait for it to come up, down, up, entry, down, up, entry, down, up. I sound like I'm training for burpees. Down, up, entry, and so on. Okay? You wait for some sort of indication that it's the right time to get in. We are training your eyes and your hands and your traders' brain. Your Forex trading, crypto trading, soybean, cotton, gold, oil, does not matter what you are trading. You always wait for a better price, no matter what. That is always goal number one. Wait for a better price. Now, we've went through the indicators, EMAs, Kazis, supply and demand zones. I do not expect you to be an expert trader after watching this video in one session. That's why we don't offer a one-session package. This is just a way for you to start to hear the terminology, see some more examples, feel a little more comfortable. There's tons of other videos you're going to watch, and there's way more time that we're going to spend together talking about trading, and you seeing my trades, me breaking down your trades. If you end up staying in the Telegram after your trial, you can do that too. You're gonna learn how to talk Forex, talk trading, see the trades, break down the trades. All that stuff is learned through experience. So now that part is done, we talk about your rules. Some of your rules. These are some of them, but these are the most important ones. When you take an entry, so for those of you who don't know, top left corner, there you have your sell and your buy. Okay? Depending on what your price is. Here I have it set at $1 a pip, and I think on the other chart I had it set at a standard. Standard and the Euro USD, I don't know, standard probably. Standard, okay. So $1 a pip looks like so, right? 0.10 is $1 a pip, meaning that every time it ticks in your direction or against you, it's $1. 1.00, standard, $10 a pip. 0.01, 10 cents a pip. Now, depending on your account size, we will talk about that on session. Everybody's different. We will figure out where your risk is going to be. Now, when you enter the market, either selling or buying, the first thing you do is, so when you set the trade, you enter the market, you get this green line. The green line is telling you you are in the market. When you go to your terminal, which is this up here, you will be able to see that you have entered the market. If you wanted to exit it out, you would hit that X. Now, I can't do it right now because the market is closed. It is Friday. But that is how you do it. Once that happens, to set a stop loss, the stop loss, the thing that everybody wants to know first because they fear losing money. The stop loss is there to stop you out of the market, take you out of the market in a negative position, right, or a positive depending on the situation. But what it means is when price, this line, when this order of stop loss, which is for this sell, would be on top of it. If you're selling, everything under you is profitable. Everything above you is bad. It's negative. If I do like this, by the way, that sound means no. It's a sound that will haunt you. Right there. I go to my entry. I go over the green line entry, and I just drag into the negative side of my market. SL, stop loss, negative 30. Let me do just that. Negative $28.82 USD, US dollars. And then it says negative 303 pips, right? Ballpark it real quick. That does not mean 303 actual pips. That means 30.3 pips. Remember, it's in micros. So don't do this, which a lot of people do, and then their first week, they're like, I don't know why none of my trades stay in more than 30 seconds. Because when you do this, you're only pushing the market 3 pips. This is 3 pips. This is a fart in the market. This is going to hit you out every single time in a couple of minutes. You got to be out here. Stop loss, 30 pips. Now, a lot of people, they ask, why not 20? XYZ said 20. I've read this and it said 20. 20 pips, depending on the pair. Regardless, I like 30 pips. 30 pips mean when you have a 30 pip stop loss, you can place that in a position structurally if you're targeting price correctly, where if they get anywhere near you, you will be able to see your stop out before it happens, and you could minimize your loss, right? What you don't want is you being so scared to lose that you can't win. You trying to nickel and dime the market and leave that stop loss so tight that you are getting tapped out. You're right about direction, but any kind of slippage or anything out of the ordinary that happens, a wick, something like here, where you get stopped out, I mean, you're trying to get in here, right? This is obvious. You're trying to get in here. This is what you want. And then they still took this market back 12 pips, right? It's really close. If it's 30, you're not worried. But, if it's 12 and it's 20 plus spread, you're worried. Right? This is the UJ, so it's slower. If you do this on the GJ, they're taking you out each and every time. They're getting you. So my point is, you want to make sure that your stop loss is something, substantial. 30 pips is a solid number. And on session, we will break down why 30 pips makes sense as far as moves. Because the market moves, depending on the pair, anywhere from 18 pips to 25, 30 pips an hour. Right? That's how it works. Right? We move about 100 to 120 pips in a 24-hour period. We go up and down every 15 minutes, in that, just do the math. Right? We're going to equate, how do we get to 100 and 120 pips in 24 hours with a whole bunch of up and down? Because if it was one-sided, the whole 120 pip range would happen in an hour. I'm exaggerating the numbers, but you get my point. It's a whole lot of up and down. So you have to account for that stuff. It also means there's tons of opportunities in the market that you're not seeing. So stop loss automatically goes up 30 pips. Now, when you are a beginner, I purposely make you place your stop loss at 20 pips. There's going to be two phases in your beginning rules, or handcuffs as I like to call them. I purposely make you place your take profit at 20 pips. Take profit. Just like that. TP, take profit. Now, if I was buying, my take profit would be on the top. My stop loss would be on the bottom. Since this is a sell, my take profit is on the bottom because I'm trying to take the market down. All right. Now, TP, I place it at 20 pips. It says 202 pips. Remember, it's micro, so it's 20.2 pips, or $18.90 because of commissions and spread. Now, what happens there is when price goes through it, it automatically takes you out. Now, eventually, you're going to be able to maneuver your stop loss and take profit. Drag your take profit a little further. Drag your stop loss into the buyer zone. You can actually do that. I can't do it right now because the market is closed. But when you're in profit, you can take your stop loss and place it into your profitable zone. And what that means is that if it comes back on you, it'll take whatever profit you have already locked in. Right? It's like a profit safety measure. So let's say the market was somewhere down here. You can have your stop loss somewhere here and lock in 26 pips. No matter what happens, worst case scenario, you take 26 pips. All right. So you set a stop loss, you set a take profit. Now, traders that have been around, or even people who are a little financially savvy, but I can't survive an investment portfolio by winning 20 pips and losing 30. Eventually, my losses are going to overcome my wins. And if I lose 2 or 3 times in a row, I'm going to murder my wins. I get that. But right now, we don't care about your profit margins. What we care about is you realizing the power of taking profit, 20, 30 to 30 pips. We also need you to survive your entries. We can't have a small little stop loss. So we do that, and eventually we will go to a 1-to-1 risk to reward ratio. But for right now, we're not doing that. We're going to go with the 20 pips in the take profit, 30 pips in the negative. Eventually, you're also going to go into something that I like to refer to as a twin entries or triple entries, which is my favorite, so that you can take profit on some of your entries and let some other entries run. Now, I will touch base on this real quick. When you are doing triple entries, if you are a more advanced trader, and we already talked about it, what that means is, let's say, for example, you were entering at $1 a pip. Instead of entering one entry of $1 a pip, what we do is we split up that entry into three entries, each of 30 cents a pip. We do that so that you have flexibility in your entries, because let's say you take this entry for a sell and it's still going back on you, you take another one. And then you take another one. And you're still under what you wanted to risk in the first place, $1 a pip. But you have 2 entries that are as sharp can be, and you also have the ability to take one of those entries and cut them at 20. It comes back here, you use that equity, enter again, and then you're good. 3 entries just running beautifully. Maybe you cut one here, now you have 2 entries all the way up here, and you just hold and drag the stop loss along. Maybe you cut this one, now you have 1 entry up here, now you're adding more. Right? You're taking that equity, that money you just made, that profit, and then you're adding more entries. And that's how you scale a trade. Right? That's how you maneuver through the structure of the market. There's a method to the madness here. So eventually you are going to be triple trading or double trading, where you split the risk so that you have flexibility to maneuver in the market, because we want to control what we can control in the market. We want to make sure that when we trade, we are maneuvering in a way that makes emotional sense. We give ourselves as much flexibility so we can stay in as much emotional control as we can. And that's pretty much it for your refresher video. 5 more minutes on a couple of points, and then we're going to wrap this video up. I've said it in other parts of the video, but just in case you played this video in double the speed or you skipped around, I wanted to make sure I had a chance to at least catch you at the end. You are not going to learn this in one video, but you're going to take big strides by watching videos and by coming to the sessions, and more importantly, trading. Remember that nothing is going to teach you better than your losses. Nothing is going to be more effective than the actual conversations that we have. And the more trades you see, and the more situations you see, and the more situations you place yourself in, nothing is going to be more effective for your learning process than that. You have to actually ride that bike to learn how to ride that bike. Right? It's that you can't learn it by watching it on a video or by talking about it. You actually have to do it. So get to trading. A lot of the times when someone has been around, has learned all the systems, and they just can't get in the market, or somebody who's brand new, the first thing I make them do is force themselves to trade. Take whatever information that you can gather and get in the market, whether it's marking up the chart on the daily, the weekly, and the H4, which is something you have to do, because we'll talk about it on the session, but you already know that you have to do that. And then let's say, for example, you're in this area and you see you're starting to break these levels, and you determine it's a sell. So then you start targeting for a sell. Is it this level? I go to my lower frame and I'm looking for the smaller structure to be able to see where my retracements level are. Or maybe I take Fibonacci's, which you didn't learn yet, but maybe I do that and try to look for these levels, 23 or 38, something along those lines. Maybe I do that, right? I figure it out through the details. I start marking up my chart. You got to trade. You got to try. You got to attempt. Maybe it's as simple as, okay, this was my high. Now this is my high. I'm taking a sell. Now, you got to know why this is important. If I go to a daily or an H4, listen, I'm in an area of supply and demand on the higher frame. I'm in a resistance zone, a big resistance zone. On a daily, I look left. Look at this Kazi, man. On a weekly, you got anything going on the weekly here? EMA 10. Look at the EMA 10 saying, what are you doing? What's going on? We've been downtrending. You trying to uptrend now? US dollar? H4. Look at this. Look at this resistance zone. This isn't a joke. This isn't something easy to break. This is serious right here. Serious seller's zone. Right? Struggle, 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 struggle. Boom. So from here, you got to determine two things. Where am I going to get in from? And if that sell goes my way, where am I going to get out? Or start to look to see what I'm going to do. I would go with something like here. And then from here, I got to determine, am I going to go lower? What's going to happen? You take it moment by moment. Remember, this is a 4-hour chart. Unless you're going to be sitting here for 24 hours straight every single day, got to learn to trust your trades. All right? Or you got to take quick profits. You know, if I was on this trade, look, I'm above the EMAs, now I'm under them, breaking under them. I'm getting level to level, right? I've hit that seller zone. So automatically my mind is going to say, all right, I'm going to get a nice retracement here. I should get a nice retracement. I should get something, right? So I can try for the sell. Didn't work here. Maybe I could try it here. Now it's starting to look like it's actually pumping some sell power. You want it to come up, to come down. Right? And then you worry about here, and then you worry about here, and then you worry about here to see how the sell is playing itself out. Never getting in on the momentum of a candle, like this crappy trade that we took for your example, but more so getting in on the retracement of a candle to take it back down. Remember that we want to do things from the sense of probability. Everything that we do brings a little control to our side and a more probable chance of winning the trade. Entering the market during actual session moves. Entering the market when the market is actually clean and you can actually see something. Price targeting, waiting for price to come to you. Not just entering just because the candle is in your direction. right? Understanding that the higher the frame, the bigger the move, the more trusted the information. Your higher frame stuff, what you want to do is you want to mark up your chart on the higher frame because you trust that info. Mark up your chart on the higher frame because you trust that information. And then on the lower frame, H1, M15, if you need the M15, for some you stop at H1, it's basically the same thing. What you do is you target price. It's your timing. The higher frame controls your bias and your ultimate decision making. Your lower frames, H1 and M15, they control your timing and your precision. They make you that much more precise to the pip, right? If you're not taking smaller trades, 20, 30, 40 pips, then the M15 serves you no purpose, right? In the beginning, and the H1 either. So my advice to you guys is to follow what we're talking about in the beginning, and then as we go, we'll figure out what you like more. Remember that the EMAs, the KAZIs, the supply and demand zones, they're just indicators helping to train your eye. They're not telling you or doing anything for you. That's not the purpose. They're training your eye and helping you to see the market just a little bit better. And eventually, if you want to be a naked trader, you can do that too. No indicators whatsoever, just your own personal markups. Remember that getting in the market from a certain position or price, right? A smart position or price, letting price come to you, finding best zones to get in from is much better than trend is your friend and I'm just going to jump in whenever I get a chance. Also remember that the stressful part of trading is not while the market is while you're in the trade. The stressful part, the careful part is before you enter that market. Every time you get in the market, you are investing your money. Think about it like if you were investing the relative that you love the most. You're investing their last couple of dollars. You wouldn't be flimsy about your decision making if that was the case. If you worked in a bank, you would get fired if you dropped the parameters you've been provided. Don't fire yourself, right? You have certain things that you're learning to give yourself the best quality trades possible. So make sure that when you are trading, you are following those parameters. When you're winning and when you're losing, right? When you're losing, don't eat like a bird and shit like an elephant. I'm sorry I cursed for those of you who don't like cursing, but that's the saying. What it means is when you're winning, don't take whatever little scraps the market gives you, but when you're losing, you're holding and holding, hoping and praying that it comes back in your direction. Don't do that to yourself. Make sure that you are just following simple rules. I set a TP, I set a stop loss, I'm going to stick by it because it's what I decided to do. A lot of the times we get ourselves in these horrible situations wishing that we could get back the situation we had 10 minutes ago, right? And that happens a lot with losses. When the loss is negative 20, negative 30, and now that person has tacked on even more entries, right? And now their loss is negative 60, 120 pips because now they have more than 2 or 3 entries. Now they have like 10 entries. They tried to fix bad entries with other entries, which is a no-no, right? They do something like this where they get in here, and they get in here, and here, and here, and here, and here. And then by the time they're all the way up here, they're out. They're screwed. Their account can't even hold it, right? And then it comes back, and they're pissed. You should have never been in this anyways. Once it takes you out, it takes you out. So you have to come to a point where everything you do is predetermined. Your rules, what you can control it. When you mark up your chart, not only do you want to mark up where you're getting in from, you also going to mark up where you think you should be getting out from, or at least thinking about it, right? And if that area breaks, then you got a new. Then you want to see more candles, right? You want to see new information to let you know what you should do going forward. Locking profit. These are all things that we talk about on every session, in every video. You're going to hear these things. When you are up 20, 30 pips, there's no shame in taking that profit. It goes 1,000 pips in your direction and you only take 30 pips. Guess what? This won't be the first or last time that's going to happen. But at least you didn't lose. And at least you caught some profits in a market where people get slapped around all the time. These are all things that we are going to cover on session. The purpose of this video was to try to cover as many things as possible so you can hear it that many more times. We covered EMAs, we covered KASIs, we covered supply and demand, horizontal market, trending market, diagonal market. We tried to do some markups. A lot of these other videos have way more markups of things going on, mentalities and playouts of the way the market was playing itself out. If you're inside of the Telegram, you get a free trial, 30 days in the Telegram. Hopefully that's still going on, depending on when you're watching this video. If it's 2020 or 2021, that may not be the case. But the Telegram is probably still around or something like it. But I'm definitely still coaching because I love what I do. Definitely still trading. If you are immersed in trading, if you do this at least an hour a day, if you do this at least 30 minutes a day, not everybody is in a position to do this all day, every day, 24/7. Take progressive steps. Mark up the chart. Set stop losses. Set places where you think that market would have came in from. All these things are going to help you become a better trader. Never step away too far from the charts for too long, because it's like starting from scratch if you haven't been around long enough. Right? If you're somebody who's brand new, be patient with your progress. Have gratitude towards your progress. A lot of times what I get is guys who are making money in the charts. I've seen people make $500,000 and they're still like, whatever. But when they lose, it's like somebody shot them, right? Understand that this is not easy. This is something that you're learning. And if you're somebody who's profitable doing this, have some gratitude. Why? Because when you're actually trading, you'll stop thinking about continuously increasing your lot size. You'll be happy with what you're making, right? You'll be happy with consistency and profitability and just the fact that you're actually growing as a trader, and where are you going to be in 5 to 10 years, right? These are the things that are going to help you become a better trader. When you make profits in this market, you don't automatically have to raise the lot size. That's dumb. What you want to do is you want to let that account grow and keep trading at the lot sizes that you're happy with. That way, you can make money that much more comfortably. You can let the trades run that much more. You have flexibility to add more entries to an ongoing trend, right? Trade other charts at the same time. We want to do things that increase our emotional control, which increases the probability of our winning. In this video, we've covered a lot of stuff. There's other videos you can watch. There's obviously sessions and conversations you can have. If you are a new student, always keep the lines of communication open. My inbox is always open. I will always respond. I've been around for a long time, and anyone can tell you, anyone who's traded with me, that I've taught, that I've helped, that I've mentored, that I've assisted in this game of trading, they can tell you that I will always respond. I don't ghost on anybody. Use that to your advantage. Not because I am the all-seeing eye of trading, but because it always helps to talk things out. It always helps to ask that question that's been lingering in your mind and bothering you. It always helps to just figure things out that much faster by having a conversation. Why suffer in silence? Talk, ask, get. And that's it, guys. Now we're done. You have officially completed the day 1 refresher video. You have officially completed your first session. You are well on your way to becoming a trader. Be proud of yourselves for actually taking the proactive steps of learning how to do this correctly, and not trying to find a shortcut and waste your money and waste your time. The skill of trading takes time, and for those of them who are consistent and persistent in their work ethic, they will eventually get it. That is my personal opinion. Nobody taught me how to do this. How I learned was through suffering. My goal is to stop that suffering with you as a new trader, to teach you the things and the mistakes that I've seen and that I personally made, that I've seen others make, and teach you how to go about things in a smart, methodical way, how to see the market in the correct fashion, how to approach the market with an actual respect that'll keep you profitable. That is my goal with all this. My goal is for you to learn how to do this the right way, what in my opinion is the right way. Okay? Take the time to digest all the information. Take the time to actually look through the videos. Don't rush yourself through the process. Be smart about your trading, get some skin in the game, and as I always like to say and how I like to finish every single video, happy trading.